Okay, good morning, and thank you everyone for joining and welcome to Things You Should Know About Federal Taxes and Your Business. My name is Steve Dial. I'm the CEO of AnewAmerica, and today's presentation is brought through our Women's Business Center in San Jose. AnewAmerica's Women's Business Center is part of a network of women's business centers throughout the U.S. that are out of the U.S. Small Business Administration's Office of Women's Business Ownership. To that fact, the Women's Business Center is in part funded by the U.S. Small Business Administration, in addition to the Governor's Office of Business and Economic Development, and also AnewAmerica as its host organization. And AnewAmerica, we're a 20-plus-year-old nonprofit in the Bay Area, and we bring business entrepreneurship training and small business technical assistance to underserved communities throughout the Bay Area. Today, we are pleased and proud to have this webinar in partnership with the Internal Revenue Service, more commonly known as the IRS. So we'll get more information on how this partnership came to fruition and what's the goal. But again, we are proud to have this program with the IRS. A couple of disclosures before we continue. So again, the Women's Business Center is hosted by AnewAmerica, but it is in part funded by the Small Business Administration. So anything that is said in this webinar does not reflect any views of the Small Business Administration. Second is, if there are any specific products or services that are mentioned, please do not consider it to be an endorsement by AnewAmerica. And the third is that this session is being recorded. So if you would not like to be recorded, you can sign out at this time. Otherwise, please feel free to remain with us to get some very pertinent information. Now, it gives me pleasure to introduce our partner, the IRS. And we have Rena Newell. Rena, she is a stakeholder liaison for the region of the IRS that covers parts of Northern California. So without further ado, I'd like to turn it over to Rena.
Well, hello, and thank you, Steve. I appreciate that opportunity to partner with you. As Steve indicated, I am a stakeholder liaison, the communication division of the Internal Revenue Service. So what does that mean, basically? As a stakeholder liaison, our main goal is to provide local engagement with the communities by partnering and building relationships with community leaders, organizations, practitioners, and business owners as yourselves. So this is a way for IRS to basically determine what the resources and tools that are needed for you all. We also share key messages with our partners, and we identify tax administrative issues or concerns members may have with IRS. In addition to that, we solicit feedback from the community, from our multicultural and underserved community, where we come together, we have meetings and discussions on specific needs and any barriers that they may have so that we can better serve them in the community and bridge any gaps that may exist. Finally, we participate in tax-related events. We give presentations, and we collaborate with small business organizations to provide tax education. So that's kind of what we do, just the gist of what we do. And I have the pleasure today, you guys are going for a big treat. Our presenter today, she has been presenting, she's been in taxes and tax and accounting experience, for over 35 years. She's a very knowledgeable individual, and I would like to give you this opportunity to get and absorb all this information because it's going to be phenomenal, trust me. Tori? take it away.
Good afternoon. I'm Tori. I am your facilitator today. So I'm going to share my screen so that you have so I can show you some slides that I'll be presenting. We have a lot of information that we're going to be covering today. To start with, I own my own business. Like many of you, I am a small business owner. I am what's known as an enrolled agent with the IRS. That does not mean I work for the IRS. I do not work for the IRS. I am a volunteer, giving my time to educating you on various items that small business owners need to know. And we're going to cover a variety of things today. So the company that I own is called Tax Goddess. So yes, I know, Tax Goddess. I worked with a tax Buddha. I worked with lots of tax people. I've been doing this quite a while, and I'm a tax junkie, and I hope that comes through as we go through this. So again, I do not work for the IRS. I am completely independent, and this is a public service that they offer. I receive no compensation. I get no preferred relationship with the IRS, which also means I can be audited just like any of you. In fact, I'm probably more likely to be audited to make sure that I uphold the standards of an enrolled agent. Okay. Like a CPA, I can represent people at the IRS in audit and such. The difference is an enrolled agent has no borders to their license. It means I can do taxes in any state of the United States. I can do international, which I have. I've helped with some expats over in Japan. I've taught in Japan a couple times. So I can do everything a CPA can do as an enrolled agent, except what's called an audited financial. And we don't do a lot of those so much anymore. So let's see. What do you need to know about federal taxes and your business? Okay, so one of the things you need to know is you're going to get what's called an employer identification number. And what I want to share with you is a very important place. It is called the IRS website. So I'm hoping you're seeing that right now. I brought up the IRS website for you on my screen. Please know that it's irs.gov, G-O-V, not IRS.com. IRS.com is not the place you want to go. Any government agency you work with is going to be irs.gov or franchisetaxboard.ca.gov, employment development department.ca, edd.ca.gov, and California Department of Tax and Fee Administration. At some point as a business owner, you may work with all of these. You may work with one or two of them. Because you're in California, you're going to be working a lot with both the federal IRS and the state franchise tax board. So I wanted you to be aware of those websites, and I'll bring them up again later. One of the first things you're going to be doing is you're going to be getting what we call an employer identification number, an EIN. You're going to need this EIN if you're going to be paying wages, if you're self-employed and want to have a retirement plan, if you're a partnership or a corporation, which we'll get into in more detail as the session progresses, you get an EIN, employment, excise, fiduciary, ATF returns. Banks, for you to have a business bank account, you're going to need an employer identification number, EIN. You apply for that EIN on the IRS website. So if you were to go back to irs.gov, you're going to, down here on this main screen, apply for an EIN number. And it'll take you through the process in the screen, and you can do this online. And it really only takes a few minutes, but you want to have all your documentation ready. You're going to have to enter things like your social security number, maybe what kind of entity you're going to be. And that's where we're going to get into more of that information, because some of you may think, oh, I need to be a corporation. I need to be an LLC. I need to be a partnership. Hopefully by the end of the session, you'll have a better idea of what works best for you as far as what type of entity you're going to want to form for yourself. And if you've already formed an entity and you're not sure that that's the right one, you can always make a correction. Don't think that you're locked into stone. It might take a little time to unwind what you've done, but we can definitely unwind what you've done. All right. So you'll see on a number of the slides, we reference a publication. These are publications that are issued and created by the Internal Revenue Service. In the case of Pub 1635, it explains in more detail your employer identification number and understanding what it is. Publications are written so that the average person can understand them, even though it's still a little bit of what we call tax speak. The Internal Revenue Code is written just like you were reading the law. So publications are usually written so that they're a little more understandable for the general public. Okay. For record keeping, you are going to want to keep all your documents that verify your income, anything you purchase, and any credits you may take. So you're going to want to keep them for a minimum of 3 years. Now you'll hear some of your friends or colleagues say, I keep all my stuff forever. Well, that's fine. You can keep your stuff forever. Of course, if you have a big enough garage, you can keep it forever, or a storage place. But if you've ever kept those little thermo receipts from the store where you've signed your credit card and you stuck them in a box to keep your receipts, and you go back into the garage or the attic or the storage unit and you pull those receipts out 2 or 3 years later, the heat has turned them black. So you can't really read the numbers anymore. So that's not as helpful in keeping those documents. You can scan them in and keep them in scanned form, even though we always suggest, in my profession, we suggest you keep the originals as proof of, yes, I had the paper copy, you just can't read it. Okay. So 3 years, 4 to 7 years is also doable. If you're working on employment tax, that is your payroll tax returns, 4 years, and that is referenced through Pub 15, Publication 15, which for any of you who may have formed businesses a while ago and are taking this as a refresher, this used to be called Circular E. Okay. If you buy a piece of business property, that means you're opening a restaurant and you buy a stove or a freezer, or a bakery and you buy a mixer, or a coffee shop, or you're doing a service-based industry and you buy computers and desks and bookcases. All of those things are assets, and as long as you have them, you're definitely going to want to keep that receipt and keep the information handy, because you may have to present that documentation in for tax purposes. All right. So, and if you haven't muted yourself, please know to mute yourself. Sometimes people have background noise that may come through while we're doing the session. So bookkeeping, there are 2 forms of bookkeeping. There is single entry bookkeeping, and then there's double entry bookkeeping. Single entry means you keep a daily, monthly, quarterly record of your income and expenses, and the main focus is on your profit and loss statement, or income statement as it can be called, and it's usually very sufficient for your tax purposes. Double entry tends to be more accurate. It has a built-in checks and balances system, and it self-balances. For every one of these, I have to have one of these. Okay. Another way we refer to those kind of entries are cash basis That means you report your income in the year it was received, deducted in the year paid, or accrual basis, where we report income when we earn it and we deduct the expenses in the year we make it, okay, or put it on credit card, okay. Inventory is going to require that we are on accrual basis. So that's going to be very important. So inventory, if you're keeping something that you're selling for resale, you are definitely going to want to be, well, you have to be on accrual basis per Pub 538 and the Internal Revenue Code. Okay. And again, if we will have time at the end of our session to do plenty of questions and answers. So let's talk a little bit about business structures. There are 4 main kinds of business structures. And when we talk about corporations, that puts us with a 5th because there's 2 different kinds. So the first entity is a sole proprietor. That means an individual forming a business and being that person, just an extension of that person as a sole proprietor. A partnership is 1 or more, 2 or more people entering into a business relationship to conduct business, to make income. Of course, everybody goes into business to make income, although I do think that sometimes my clients go into business to lose money to offset their other income, and that isn't necessarily a business. That may actually be a hobby, and there's special rules for that beyond the scope of what we're talking about today. Then there is an LLC, a limited liability company, or an LLP, limited liability partnership. And we'll get into some more detail on that. And the idea behind the limited liability company is it limits the amount of risk that the people involved in the company or partnership are exposed to in the conduct of business. Okay, and again, we'll get into some more detail on that because I know that a lot of people form an LLC because oh, I saw this commercial, I saw the help yourself legal commercial and said I could form a business entity through them, and so that was the one they said to do, and that isn't necessarily the right one to do. You also will not hear me through the course of our session reference a specific product. I may speak in terms of generic bookkeeping systems that are online or desktop, but I do not endorse and I cannot endorse any specific products in the course of this. Those are things that I'm willing to talk offline with you about. So otherwise, I am not going to be mentioning the names of any franchises or local companies that offer any kind of software to assist you with your bookkeeping or accounting or anything like that. The 4th type of business, 4th and 5th type of business structures are the S corporation and the corporation or C corporation. So they're both corporations. One just does things a little different than the other. So let's start with some more information on the sole proprietor. A sole proprietor is not incorporated. Incorporation pretty much lends itself to being a corporation, all right? It's owned by one person, which means that one individual can use an employer identification number or a social security number, okay? I usually suggest that someone who is a sole proprietor get an EIN number, because if you're a sole proprietor and you're working in a service industry, you're going to have people asking for your social security number or your tax identification number, EIN, for the purposes of issuing a 1099. And with the amount of fraud, unfortunately, that goes on these days, an EIN helps protect your social security number from people scamming you or taking it and running away with it. So if you're going to open a business and you're using your sole proprietor and using your social, I would get over to that irs.gov website and apply for an employer identification number through the SS4. The other side is the owner assumes all the risk. That means you as a sole proprietor are liable for everything to the extent of all your personal assets, all the business assets. They can come right after you if they sue you. If you're an electrician and you wire a multi-million-dollar home and you miswire that multi-million-dollar home and it burns down, they're going to come right after you and your assets, your personal business. There, you don't have the protection, even though you might have a great liability insurance policy, which of course I suggest every business owner have a liability insurance. It still means they can come after you personally. In order to file your tax return, you're going to file the Form 1040, just like you always do for your regular income taxes, but now you're going to add a Schedule C and possibly a Schedule SE. The SE stands for self-employment tax. As a sole proprietor, no one is withholding Medicare or FICA, Social Security or Social Security Medicare, from your income. You are responsible for paying it yourself as a sole proprietor, hence the self-employment tax. Now, there are such things as a qualified joint venture. Joint ventures usually happen with a husband-wife, domestic partners, husband-husband, wife-wife, whatever marriage form there is a legal tie to the two people involved in doing a joint venture. Partnerships. Partnerships are actually kind of a glorified sole proprietor. They're not incorporated. They're very easy to organize. The members or partners contribute money, property, labor, or skills, sometimes referred to as sweat equity. Even though there really is in the Internal Revenue Code, there is no such thing really as sweat equity. It gets a little more complicated. The members share in the profits and losses, and the decisions and the authority are divided amongst the partners. And sometimes there's a majority partner, that one partner who has more than 50% or holds the largest percentage of the majority. Limited liability of the partners is usually unlimited. Now notice we've talked about briefly the limited liability company. In a general partnership, liability flows through to all the partners. Form 1065 is the form that you will file. Each partner will get a Schedule K1. And the publication issued by the IRS that goes into more detail is the Pub 541. This is also the first true flow-through entity. And what I mean by flow-through entity is it says that the members share in the profit and losses. The business entity prepares its income statement or loss. So, and then the percentages of that income or loss goes out to the individual. It flows out of the business and out to the specific partners. That's what makes it a flow-through entity. And a sole proprietor is also a flow-through entity because the Schedule C flows right on to the Form 1040 individual tax return. Limited liability company. The owners will have limited personal liability, whereas in the partnership, it's unlimited. Okay, it's a flow-through entity. The income flows out of the LLC and onto the individual members. And in a partnership, in a LLC, we usually refer to the people as members instead of partners. Now, the interesting thing is an LLC, limited liability company, is an entity that was formed by attorneys, and it was formed at state level. There is no LLC tax return form in the Internal Revenue Service. the Internal Revenue says you must file as a disregarded entity. We don't recognize an LLC as an entity that's been formed under the Internal Revenue Code. So if you're a single member LLC, you would probably and most likely file a Schedule C, and that will be on your regular 1040. If you are multiple members, you may elect to treat your LLC as a partnership or an S corporation or corporation. They are flow-out entities. The complication in California is you must file a separate entity return for that LLC. So you have to file a Form 568 with the state of California. And that's our lovely Franchise Tax Board. Okay, so you can get more information from them there, but know that there's an extra set of form filings as an LLC. It also, the IRS wants to know how you're treating that entity, so you must submit Form 8832, which is the election to classify your LLC as either disregarded single member, to be an LLP, or a partnership, or a corporation. And I would honestly, I say the LLC is the most complicated of all the entity types because it's more of a legal entity than a business entity. So they're not my favorite personally. I really enjoy corporations. Of course, I enjoy any kind of tax form. Now we have the S Corp. The S corporation is formed when the shareholders, because you can only have shareholders in corporations. You can only have stock in one of the two corporation types that we're going to be talking about. They are taxed like a partnership. So if they're taxed like a partnership, that means it's a flow-through entity. The profits and losses come out of the corporation and get passed among the shareholders, usually based on their stock share percentage. Okay. They file Form 2553, an election to file as an S Corp or election by a small business corporation. If there's a question, I'll catch that at the end. Please make sure you're on mute. S corporations don't pay tax on income from the daily basis. Again, it flows out to the shareholders by the form of a Schedule K1. Just like the partnership issues a K1, an S Corp will also issue a K1 to its shareholders, and that will flow on to their personal 1040s. Corporation. A corporation is a legal entity separate from its owners. That means in the eyes of the government, IRS, Franchise Tax Board, Employment Development Department, Sales Tax, California Department of Fee and Tax, it is an individual. It is its own person. It has rights and duties on its own ability. It has its own rules and laws that it has to abide by. Owners are referred to as stockholders or shareholders. The liability is then limited. So what happens is, let's go back to the electrician. If the electrician had opted to be a corporation instead of a sole proprietor, burnt down the house, the homeowner would go to sue said electrician, and he is protected and he's behind the wall of the corporation. Sometimes you'll hear it referred to as the corporate veil. It is a wall that is between the owner, the shareholder now, and the corporation. The corporation stops and says, you have to sue the corporation. And the shareholder is protected as long as they've obeyed all the rules of being a corporation, not taking draws or not using corporate funds for personal expenses like going to Vegas or Reno or Atlantic City and gambling away the profits or things like that. The nice thing is you can easily transfer ownership in a corporation. You sell stock. You might start as a 100% share owner in the corporation and you want to raise some revenue or raise capital. So you're going to sell off some of the stock to another shareholder. The other thing that's really nice about a corporation itself, it's subject to its own tax. It files its own tax return. It pays the tax. Nothing flows out to the shareholders. So, I mean, there are a few little rules about corporations, which we're going to get into next, but it has its own tax and its own tax rate. So in the past, there was always this misnomer about double taxation. Oh, if I'm a corporation, I'm going to get double taxed because I have to be an employee of the corporation. So I'm going to get taxed as an employee and then I get taxed as a corporation. It doesn't really work that way anymore. It may have a long time ago, but yes, as a shareholder, you are usually an employee of the corporation and the corporation pays you wages. Well, the corporation deducts those wages from the profits. So it's not paying tax on wages that it pays you as an employee of said corporation. Another way that they get income is it's distributed as dividends. That is a return on the investment that has been put into said corporation. They can apply, they have to apply usually to the Secretary of State. In the state of California, a corporation must submit a request to the California Secretary of State for the right to do business in the state of California, and they pay a minimum fee of $800 every year for that right to be a corporation in the state of California. You also pay that $800 if you're an S Corp. You pay that $800 if you're a limited liability company. You don't pay the $800 if you're a partnership, because the partnership is just, like I said, it's almost like a glorified sole proprietor. The corporate entity files a Form 1120 with the IRS. It files a Form 100 or 100S with the state of California. Okay, so let me stop that share for a moment. So I'd like to go ahead and open this up to a few questions. I'm going to check the chat and see if there's anything in the chat right now. Let me see, get over to the seminar. Oh, I don't see any questions in the chat. I do see that somebody asked about the slides. The slides are not available, but there will be a recording of this session available. I am going to put, as I said, I'm not allowed to endorse specific products. You're welcome to unmute yourself at this time to ask questions. I am going to put my personal email in the chat box so that if you have questions that you want a little more information on specific things or specific to your situation that are a little bit beyond the scope of our session, I'll be happy to answer them offline. Let's see, can I use cash basis? Yes, you can absolutely use cash basis if you're an IT consultant because you're a service business. Actually, I find that most service businesses tend to be cash basis. It's, yep, my income comes in. The difference would be is if you're going to send out billing for a client and that you send a bill out in December and the client doesn't pay it until January, yeah, you might be stuck with a little, well, okay, your cash basis. So a common thing that I have known some business owners to do in the past is, oh, I'm not going to put the money in the bank. I got a whole bunch of checks in December, so I'm going to wait until January to deposit them because then I don't have to declare the income until January. That's not true. You had access to those checks in December. And in an audit situation, the auditor would look at those deposits in January and say, you know what, those checks came in December, you held on to them because you had access to the funds, it's income. So you can't necessarily get away with playing that, oh, I'm just going to deposit them all in 2 or 3 months and report the income then. It doesn't work that way, sorry. So Mary, I want to start a small business. However, the plan is still in the early phase. Ooh, so much of the costs that are incurred before you submit your LLC. Okay, so I would track everything that you're expending in the startup phase of your business. Keep all your receipts, keep everything, because there is this thing called startup costs. It's a little bit beyond the scope of what we're talking about. That's more of a tax situation. And I'm not covering full-blown tax situations. For more information on that, anybody who's attending the seminar today, if you email me, I'm happy to give you up to 30 minutes of free consultation time for some basic questions. But if you ask me to start running numbers, I have to charge you because it takes a lot of time to push those numbers on the calculator. Okay, so, but keep track of those expenses. They could be startup costs. And it's all a matter of timing. How long before the start and how long after the start were those expenses incurred? And you know, is an LLC really the right entity for the type of business you're going to be doing? Okay. How would you prepare a balance sheet if you were to do accounting on cash basis? You normally don't need a balance sheet if you're doing cash basis. A lot of the online programs or bookkeeping programs will create a balance sheet for you. You just have a cash basis balance sheet. It won't have anything like accounts receivable or accounts payable on it. It'll still list your assets and it'll still list your loans and your equity. So that it could be a very basic cash basis balance sheet. Most cash basis businesses really rely on that profit and loss or income statement. Do you have to get an employer identification number even if you don't have employees? An employer identification number protects your identity as a sole proprietor. If you form a business entity such as a partnership, a corporation, an S corp, an LLC, even though it's because it's a disregarded entity, you do have to have an EIN because that separates the business entity from you personally. It's just like a sole proprietor should have a second bank account, one bank account for the business, one bank account for the personal. So I've recently been working with a corporation in the San Diego area where they're having a hard time understanding that they are not the corporation. They are the shareholders of the corporation, but the corporation is its own person. And they are actually required to report to the board of directors or the president and secretary of the corporation. They don't just get to act like sole proprietors running around and doing whatever they want. So identity theft, again, I'm just going to reiterate that identity theft is so rampant that EIN number becomes such a good way to protect yourself if you're in business and not having to give out your private social security number. Any other questions? And again, I welcome you to unmute yourself if you want to ask out loud or have a chat. You're tired of listening to my voice. Oh, I don't see any more questions coming through. I'm going to put up the a news phone number and website. There you go. there was a nice large group of you guys today.
And again, here, we'll give one more opportunity. So if you do have questions, feel free to unmute yourself or ask via the chat. And it looks like there's one that came through. Can you discuss more about home tax deductions? Home office tax deductions.
I could spend a whole day just talking about home office deductions. You can take a home office deduction as long as it's regularly and exclusively used for business. I'll give you a general overview since that's not really the purpose of our class, but I'm happy to give you a general. If you're going to use a spare bedroom in your house, it has to be exclusively for business. That means you can't be doing anything personal in that room. A lot of times when I'm working with clients who have a home office, I tell them I'm going to come in and audit their home office, because in an audit situation, if you have a home office, the auditor may want to come and see your home office. And if they walk in and see toys on the floor, or they see a bed in the room because you changed a spare bedroom, how is that regularly and exclusive for business? So you have to be careful about what you might have in that home office and how much square footage compared to the rest of the house. So that's kind of a general overview. Those are some of the things you need to know and be aware of.
Okay. So one more time, we will open it up for any questions. Again, feel free to unmute yourself or ask via the chat. And as in an auction, going once, going twice.
Oh, there it goes. Does an IT consulting company with clients all around the US can establish its business anywhere in the US, or does it need to be in the state the owners live? Okay, so that's the first thing I'm going to say is you can offer your service anywhere because you're in IT. Where is home base? It's what we call nexus, or a physical presence. I will hear a lot of people go, well, I'm going to form a corporation in Nevada. I'm going to form a corporation in Delaware. Where is your physical location and where is most of the work being done? If that computer for your IT consulting has its footprint in California, you are a California business and subject to California tax. Now, if you go out to the state of Arizona and set up a business in the state of Arizona, or you conduct business in Arizona, how long are you going to be in Arizona? Are you setting up a whole home office for your travel, or are you just going and doing a few work things and then coming home? I travel a lot for teaching and for taxes. I have clients, like I said, all over the country. I have flown to Idaho to just do a tax return or to work with somebody's business for a week and then fly home. That's just short-term travel. It doesn't require me to file a tax return in the state of Idaho. It requires me to file my taxes in California and take a deduction for those travel expenses, as long as I didn't do any sightseeing. Went down to San Diego recently for a client down there, was there for a week. Because I specifically went for business purposes and did nothing but work there, those deductions will be 100% deductible. But if I decided to take a trip to SeaWorld for a day instead of working, or decided to go play golf or go to the beach, then I have to prorate the expenses based on personal time and business time. So I'm hoping that gives you a good answer for what you're needing to know. Okay, so you're visiting in other clients in other states frequently. Let's talk about how frequently that would be. And this sounds, Krish, this may be something that we want to talk on offline on, because it sounds like you need something real specific. if you were a professional sports player, I'm a baseball hockey girl. So if you're a baseball player and you are making the millions of dollars that a baseball player makes, and you travel from San Francisco to Philadelphia, and you're playing in Philadelphia, in that case, as a professional sports person, they are required to pay taxes in that state. And I've worked with some professional sports players, football players in the past, so they have to file multi-state returns. So I think I'll need a bit more personal and direct information to give you a better idea of if you'll have to file taxes in those other states.
And it looks like we don't have any other questions. So I would like to take the opportunity to thank Tori for her time and for sharing her knowledge and expertise with us today. We deeply appreciate it.
Thank you. My pleasure.